The Fixed Income Puzzle, Stacking Risk in a World of Complacency. Introduction, The Puzzle Beneath the Calm. In the summer of 2025, the corporate bond market is broadcasting a strange message. On the surface, everything seems calm, almost too calm. High-yield bond spreads have tightened to just 3.01% above U.S. Treasuries. That's the narrowest differential in over a decade, a level more commonly seen in boom cycles than in a world still digesting post-pandemic fiscal hangovers, geopolitical friction, and uneven global growth. To the casual observer, this tight spread suggests confidence. Investors see little risk of corporate defaults and are willing to accept minimal compensation for taking on junk-rated debt. But under the hood, the mechanics of the market tell a different story. One of maturity transformation, forward-loaded risk, and a financial structure that requires near-perfect alignment of future growth, solvency, and policy stability. This is the fixed income puzzle, a layered, dynamic game of risk and reward where the real danger isn't loud, chaotic panic, but quiet, systemic complacency. Section 2, Foundations of the Stack, Understanding Fixed Income. At its core, fixed income is simple. You lend money, and in return, you receive fixed interest payments over time, plus the original principal at maturity. But within that simplicity lies a highly stratified market of borrowers, each demanding a different yield based on their creditworthiness and perceived risk. From U.S. Treasuries, backed by the full faith and credit of the government, to speculative corporate junk bonds, the spectrum is wide. And each tier comes with a trade-off between predictability and yield. The higher the potential return, the greater the assumed and sometimes hidden risk. Key concepts like the credit spread, the difference in yield between a bond and the risk-free rate, allow investors to price risk. The wider the spread, the higher the risk premium demanded by the market. The narrower the spread, the more confident or complacent the market has become. Right now, we're seeing one of the tightest high-yield spreads in recent memory. 3. The yield stack, a tiered credit hierarchy. To make sense of the current environment, we need to visualize the credit market as a stack of risk tiers, ordered by yield and perceived safety. Tier 1, U.S. Treasuries, 4%, the baseline, considered risk-free, used as the benchmark for all other fixed income securities. Tier 2, investment-grade corporate bonds, 4.5 to 5.5%, issued by stable, highly rated firms, slightly higher yield for modest credit risk. Tier 3, high-yield junk bonds, 7%, the headline tier, issued by companies with higher leverage or weaker fundamentals. Current spread over Treasuries is just 3.01%. Tier 4, mezzanine debt, 8 to 12%, subordinated, often illiquid, a hybrid between debt and equity, common in private equity financing. Tier 5, distressed debt, 12 to 20% plus, issued by companies near or in bankruptcy. Huge yield potential, but extreme risk. Tier 6, emerging market debt, 10 to 15% plus, issued by governments or corporations in developing nations. Currency risk and political instability drive spreads. Tier 7, private credit, direct lending, 10 to 15%, loans made to small or mid-sized private companies, often unrated and illiquid. This stack functions like a pyramid, but in today's market, the layers are compressed, and the premium investors are receiving to climb higher is unusually thin. Section 4, Complacency at the top. The illusion of safety. A high-yield spread of 3.01% might seem generous in a vacuum, but compared to historical norms, typically 4 to 6%, it suggests some market pricing in near-flawless execution from the most fragile borrowers. UBS and other analysts have raised red flags, pointing to what they call signs of complacency. The idea is simple. When investors stop demanding a meaningful premium for risk, it usually means they're either overly optimistic or missing something. The core illusion? That yield alone signals safety. But in reality, tight spreads are not a signal of health. They're a symptom of crowd behavior, driven by a prolonged low-rate environment, portfolio constraints, and the desperate search for return in an aging bull market. In short, the market's guard is down. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5, The Machinery Underneath, Maturity Transformation in Action. To understand why this tight spread might be a trap, we need to zoom in on how many of these high-yield bonds actually function. It all comes down to a process known as maturity transformation. Here's the game. Companies issue debt today, often for 10 years, and use that capital to fund expansion, refinance older obligations, or keep the lights on. In exchange, they commit to paying a fixed interest rate, say 7%, over the life of the bond. The bet? That future earnings will more than cover today's borrowing cost. But this model only works if the future arrives on schedule. If revenue falters, margins compress, or interest rates stay higher for longer, the model breaks. Debt payments become a burden instead of a bridge. And because many of these companies are already heavily leveraged, they're playing a dangerous game of cash flow roulette. At a 3.01% spread, the market is signaling that this risk is low. But the mechanics tell another story. Many firms are refinancing older, lower-cost debt at today's higher rates. Coverage ratios, earnings relative to interest expense, are deteriorating, and refinancing windows may close if spreads widen suddenly. In other words, these companies are front-loading their risk, hoping the economy stays strong enough to validate the bet. That's not investment. That's gambling with better branding. Section 6. Historical parallels and flashpoints. This isn't the first time we've seen spreads tighten to dangerous levels. History offers a sobering perspective. 2007, before the financial crisis, junk bond spreads narrowed dramatically. Investors were hungry for yield, blind to systemic risks in housing and credit markets. When the music stopped, spreads blew out, defaults spiked, and many were left holding the bag. 2014, oil prices collapsed, crushing energy sector high-yield bonds. Spreads widened by hundreds of basis points almost overnight. Those who had stretched for yield without understanding sector exposure got burned. 2020, the COVID shock caused spreads to spike above 6% in weeks. The Fed stepped in with emergency support, but the lesson was clear. Complacency can vanish overnight. Each time the warning signs were there. Compressed spreads, optimistic earnings projections, underpriced risk. Each time investors said, "This time is different." It wasn't. Section 7. Signals and scenarios. What could go wrong or right? Let's imagine 3 possible futures. 1. Soft landing scenario. Growth meets expectations. Inflation cools gently. The Fed holds or even cuts rates modestly. Result? The tight spread holds. Investors earn their 7%. Complacency gets rewarded for now. 2. Hard landing scenario. Growth stalls or contracts. Corporate earnings fall. Default rates rise, especially in the weakest tiers. Result, spread spike, bond prices fall, total return goes negative, investors reprice risk, too late. 3. Policy shock or liquidity crunch. Treasury issuance floods the market, crowding out corporate debt. Foreign buyers retreat. The Fed tightens unexpectedly or delays cuts. Result, even safe assets get repriced. The stack wobbles from the bottom up. Each of these futures is plausible. Which one materializes will depend on factors no single investor can fully control. But what investors can control is how much margin of safety they demand, and right now there's not much of it left. 8. Conclusion. Solving the puzzle or playing the game. Fixed income isn't supposed to be thrilling. It's supposed to be reliable, boring even, an anchor in a portfolio. But when spreads compress, solvency is assumed, and risk goes underpriced, fixed income becomes a speculation in disguise. Investors are no longer solving for yield. They're solving for sequence, survival, and stability in an increasingly unstable world. The stack we've explored, U.S. Treasuries to distressed debt, isn't just a ladder of return. It's a tower of assumptions. And when too many of those assumptions go unchallenged, the entire structure starts to lean. Right now, at a 3.01% spread, the tower looks polished, balanced, profitable, but so did every tower right before it fell.